It's Tuesday, 12/12, December 12th, and I did not make a video yesterday. Been super busy, very tired, but it's okay, making up for it today. Um, I haven't been making any money in the market as of late. I'm down to 41,655, as you can see over here. What else did I do? I just bought a share of Apple at 169. I think that Apple is, I mean, I'm not an analyst or anything like that, but just from an overview, like a consumer perspective, I think it's pretty undervalued. Um, Obviously, I don't know the ins and outs of the company, even though I have a lot invested in it, but it's based on things other than their numbers. I have run down through their numbers. I know what they look like. Um, I'm not as good as at reading the numbers on their balance sheet as most major analysts or most analysts, period. But I just have a sense of, I'm trying to tap into the sense of, okay, what do I know about the company that nobody else does? And I'm trying to use that edge to my advantage to help me with my investing. All right, now, um, so now I own like 24 or something shares of Apple. So let's see. Other important things that happened. EXK has been going nowhere. It's sitting at 190. Look at this flat line. No one's buying or selling this. Nobody gives a crap about EXK. Markets have a downward bias. Um, they ended up roughly flat today. Some things went up, some things went down, obviously, but mining sector pretty flat. Precious metals pretty flat. Uranium pretty flat. Everything's pretty flat. Not very exciting. Spotify down. China's up a marginal amount, and Stone Co making modest gains. Brazilian companies. So what I want to talk about is like the macro monetary tightening picture, okay? Because macro matters, everybody just focuses on micro, not everybody, but value investors, most of all, focus on the micro and they just try to make their best decision based on the information they know about the business and they just don't worry about political and macroeconomic shifts and all that. But I think that it actually, you can get a lot of information from that, and many people are focusing on things like the 10-year yield of the U.S. Treasuries. Is kind of like the benchmark cost of money for the world. Most of the world, I think like 60% or something like that of the world transacts in dollars. A lot of financial transactions are happening in dollars because it's kind of like inverse thing. Because there's so much liquidity in the dollar, it makes it valuable. It's kind of a perverse anti-economics thing, but that's, that's how money works. Like if something is readily available and holds value, I mean that gives it even more value. So without getting to the weeds of, dollars actually don't hold value or whatever, we're not gonna talk about that. What we are gonna talk about though is that there's a lot of dollars out there, a lot of dollars, a lot. And now that the interest rates are going up by decree, the price fixing at the Fed is causing all kinds of problems. Obviously, in the emerging market, emerging markets are even preemptively selling the problems. They haven't even occurred yet for most of these companies. We haven't heard a lot of big companies having troubles with their dollar debts in the news yet, but the EMs are selling off preemptively. If you see, if you look, you can look at this EDF, right? This fund that I own, which I mean, don't buy this fund for many reasons. Only I can buy it. I mean, okay, that sounds stupid. You can buy this, but make sure you research it well and what it does, all right? Don't blame me if you buy it and lose a bunch of money on it. All right. So, but it has some relevance to the. Okay, let's just pull up EM. So this is the emerging markets ETF, and you can see how there's a downward bias here ever since January 2018. and the problems are expected with the raising of rates, and they haven't actually even come yet, but the market's already taken a big hit over the last year. So, but the thing is, I think this is false. Um, I think that the Fed, even though Powell like Powell is the Fed chairman, the one that's kind of like, the most influential figure at the Federal Reserve, the one person that has the most power in the world, and is responsible for, with along with the other chairman, for setting the price of money around the world, basically. So he talks a talk book, meaning he talks a tough book, meaning that you know, he's gonna keep raising rates, basically. Some people interpret his comments to be to when he has press conference or whenever he talks to the public, that to mean that he's not that hardcore about raising rates, but he's gonna raise rates in December here and possibly even next year a couple more times at least before we see some major problems. But the thing is, what I'm thinking is that I don't think the Federal Reserve, I don't think the politicians, I don't think the general populace has any tolerance for these downturns. You saw what happened in 2008, Occupy Wall Street. Everybody was mad you know, at America for their housing crisis and all that stuff, and that's not gonna happen again. I mean, 2001, fine, it was just like an isolated bubble. They thought it was a one-off, okay, bubble pop, big deal. But 2008 was like a market broad global type of recession. There was a lot of pain around the world everywhere, and I think that the Federal Reserve has learned its lesson, and they know that they can influence that. They know they can influence the markets. So the next crisis is not going to be a liquidity crisis. It's just they know what pillars to pull, and they're going to start pulling them even preemptively, right? They're going to start pulling them. They're going to pull the trigger too soon. The market's going to go the other way, and all this money is going to spill everywhere. That's my thinking. I'm not looking for another 2008 style big drop recession market crash. You know, I'm looking for more acceleration in the expansion of the monetary supply and more appreciation of asset prices out there. You know, I think that the financial inflation, the financial assets, they have inflated probably faster than consumer goods, but the thing is, it's what's gonna feel it the most because they know how to drive it. They're gonna drive the liquidity through the financial system, and that's what's gonna hit first before the general populace, before the consumer prices, and before the regular Joe on the street feels it. So that is my hypothesis here, and I don't know if it's gonna play out. I'm more confident than that scenario than a big 2008 style crash or 87 or 2001 style crash. I don't think that's gonna happen, even though we're like 10 years nearly into this expansion, quote unquote, this very slow economic quote unquote expansion. It seems like more of a flat line to me rather than expansion. Um, so it looks more to me like the post 1929 drop where the market went sideways for like 10 years or more. That's what kind of this 10-year market looks like to me, even though because the debate, what we were measuring the market with before, well, actually, that's probably not a good argument since gold went down, but the thing is, the money was different back then, the measuring stick was different, but you could argue that it was kind of a sideways economy after the 29 um, depression start, market crash. But anyway, that's what it feels like to me. Not that I was there and lived through it, but just from observing numbers and you know, because there were progressions. Look, there were a lot of technological progression in the 30s, during the depression. I mean, cars got better, everything got better. There's a lot of technologies that were developed. Like life went on. Just because the market was moving sideways doesn't mean that everybody was like starving and begging for food on the streets. Like things were happening. Um, you know, it wasn't as bad as the market made it out to look. And this quote unquote depression that I'm calling it isn't all bad either. There's a lot of people that developed a really nice lifestyle during the 30s, as well as there being a lot of people. Trust me, I live in Silicon Valley here, where a lot of people made a really good living for themselves. But the majority of the populace of the country of the U.S. are not feeling those gains. So I think for the broader person to feel it, um, there's gonna have to be a more radical shift. But I don't think we're there yet. I think there's gonna be a blow off top to this big bubble, and we don't even know what's coming. You know, it's not gonna be a big crash that we're afraid of. It's gonna be that big asset inflation. That's it for now.